So I want to start by talking today about closing the wealth gap and why is it important to actually discuss this subject. The next step would be, after we discuss what the wealth gap is all about, how do we actually address it and what can we do on a personal level to be able to basically grow our wealth, and what is the best approach for that. Now, as Selma mentioned, we started the Sarwa 3 years ago because we really felt a need in the market that there is a gap when it comes to investment options here. People either don't know how to start about it, don't know that they can invest, or they didn't even have the options to do that. And investing is important, and we will address why. What is important to know is that whatever I'm going to say today should not be taken as a one-on-one advice, a financial advice, because we really, each one of us has to do their due diligence to understand financial advice really varies from one person to the next based on their financial situation. But overall, what I can tell you is what we're always saying is we can use data and we can use historical numbers and we can use research to be able to understand what's the best approach to growing wealth, to investing in general. But ultimately, no one really knows what's going to happen in the market. That's something just keep in mind. There's no crystal ball and there's no cherry picking, as we like to say. Now, I'll take a very quick step back and I want to talk about, numbers in the world. And specifically in the US, there are a lot of amazing advancement in different ways, as Queen Noor, Her Majesty Queen Noor was mentioning. The reality is there's still so much to be done. If actually we looked into the last report by the World Bank, it looks like instead of closing the wealth gap that women face, it's starting to widen again. And there's different reports out there that tell you it could take up to 200 years. The reality is women own 32 cents for every dollar owned by men. And that is in the US specifically. And that's really for white women. Numbers are even less for minorities. If you look into the world, the reality is men own 50% more wealth than women. Why is that? There's a lot of different variables behind it. The reality is we face a lot of gaps, right? We talk about the salary gap, we talk about the career gap for women in the workforce. There's also a lot to be attributed to the unpaid care that women do. And that's a big issue. So ultimately, the reality is we own less wealth. But there's another reality that we also face, which is we live longer. So it's good news and bad news. We actually outlive men, but at the same time, we make less money, Salma. So what happens when we're actually generating less money and not investing? We actually end up retiring with 2/3 of the money that men retire with. Now, there's a lot of studies out there that show you that for the same work that women do and men do, you actually accumulate a lot less wealth because women also not only make less money, but they do not invest. They don't start to invest. And investing is important. Why? If we look into the biggest wealth mistake that we face is the fact that if you're not investing, you're actually putting aside 4.3% of returns that you're not even tapping into. And why is that important? So if, this is what's happening in the world, Salma, and specifically in our region, right? There is a big financial, economical crisis happening in my country of birth, so back home in Beirut. But if we are in a lucky situation where we actually have work and we're generating income and we're saving that income, it's a lot of people manage to put aside. But when it comes to women, what we've seen is the majority of women actually save their money in cash. So they save it and it's liquid. It's sitting in a saving account, which is for a lot of people great because ultimately it gives you that sense of safety. But in reality, it's actually losing to inflation. There was an article here in Dubai a few days back that was about the price of a shawarma, a sandwich, a shawarma sandwich. And the article was mentioning that a few years back, you know, the shawarma was at 5 dirhams. Today it's at 25. The reality is, it's a simple example to show you that cost of living is increasing. So when you have your money that's sitting aside, your money that is worth, let's say, $1,000 yesterday does not have the same value today. It's actually losing to inflation. And on average, inflation is 2 to 3% per year. So if you're not investing that money, your money is actually losing value. But I want us to actually take a quick step back. So Salma, we were discussing earlier in the panel that, you know, when we talk about the future for women, we talk about education, we talk about financial education. And the reality is, we don't do much of financial education for our kids. I have a little daughter and I'm trying, she's very small, she's 4 years old. So I'm trying to really get her to understand the importance of that. The first step to financial is really taking control over your money, right? So what do you want to do? You want to create a budget. It's potentially easier said than done, but there's a simple rule that we like to go back to, and it's not necessarily, you know, to be taken by, you know, the word, but it's just a general guidance to actually start thinking about budgeting. So the 50-30-20 rule states that you look into your income sources, whatever money you're actually bringing, and 50% of that income goes into your needs, which are your housing, your education, you know, food on the table, the healthcare, insurance, so on. So everything you need to thrive and survive. Beyond that 50%, you want to take around 30 to basically, you know, try as much as you can to enjoy life. So we're not saying do not have your cup of coffee and don't have, you know, from time to time go out with some friends. No, do enjoy life within the balance of what's, you know, reasonable and what you can afford, and keep it around 30%. Now, beyond that, that 20%, you should really think about three things. First, an emergency fund. So put that money aside to have an emergency fund to repay your debts and then to start investing. So very quickly on the emergency fund front, what does that mean? So you want to basically try to put aside 3 to 6 months worth of living expenses. This is in case of emergency. You know, recently we had the pandemic, and I'm living in the UAE, and I've seen a lot of our friends and family losing jobs. And it was tough to survive. It was tough to be able to pay rent. It was tough to be able to get food on the table. So it's extremely important to start building whenever you can towards that emergency fund. This is going to be your safety net in case something happens, right? So that's the first point. Second, so Salma, here we're talking about that 20%, okay?
Yes.
So second point is you want to do the debt management. So you want to try to avoid debt. And of course, there are different types of debt. You have the good debt and the bad debt. But what you want to really try to close first are the debts that are dragging you down. Let's say you have a house where you're paying a mortgage, and that mortgage is higher than what, you know, maybe you're getting rent for that house. So you want to look into your net returns, and if the net return is positive, that's a good thing. But if it's negative, then you really want first to do an avalanche method by which you actually start eliminating these debts and by paying off your accounts that have very high internet interest rate. Internet, because I'm facing internet issues, so it's coming to mind. So what you want to do is consolidate the debts that you have. And once you do that, so you have the 50-30-20 rule, that 20% we said we're going to do an emergency fund. Beyond it, we're going to close it. So what do you do after that? You invest. And Salma, you know, the first most important rule to investing is starting. We've met Salma and I the other day, of course, within social distancing. We've met over coffee and we were discussing investing and how do you start about it. And we get asked this question a lot at Sarwa. And the reality is you just start. What I've seen from my own personal experience is we currently have 80% of our database that is men and only 20% that are women. Now, what I also, whenever we look into data, the reality is when women go to our platform, they actually convert, they fund their account. But to take that step to come to the platform itself, it seems like it's the hardest part to do. Compound interest is the eighth wonder of the world. So for anyone who is listening to us today and who's in finance, I'm pretty sure this is very, common information, but this is a saying attributed to Albert Einstein. And basically what that means is when you're investing, your money is actually making money on top of itself. So I want to take a small example, and I want to say you manage, to save $10,000 aside. Now that $10,000, you're actually putting it in a saving account. In 30 years, you might, maybe a saving account can give you, let's say 1% or a bit more. But the reality is when you're investing that money, the impact of that dividend return year on year on year on year and month on month on month, it's actually growing exponentially. So that $10,000 that you invested today, in 30 years, if you're actually making 5%, which is a balanced portfolio, it's a conservative investing portfolio, not conservative, but balanced. That money after 30 years is actually making you $30,000 without you doing anything. So this is when we say your money is working for you in the right way. I want to take two friends, Gina and Rina, and they're, Gina is 35, Rina is 45, and they decided, they want to start investing. So they managed to put aside $5,000 a year, and they're actually putting $5,000 every year until they wanted to retire by the age of 65. So that's basically a total sum for Gina, that's $150,000. And for Rena, it's $100,000. So ultimately, this is a $50,000 difference between the two. But if actually we look into the effect of compounding, these 10 years on a 7% annual return ended up giving Gina double the amount that Rena would have when she's retiring. So they have, okay. So did I tell you that, they invested $5,000 a year? All good?
Yes.
Okay.
I think we are on next slide.
Perfect. So here we go. We've been here before. It's something we hear a lot of times. What if now is an unprecedented time? What if the pandemic was something that we cannot get over? The reality is, if you look into the history of the stock market and you look into it from the birth of the stock market, it really started with there was a big Wall Street crash. There was Great Depression, the Second World War, going back all the way to the 2008 crash. There is one trend that is clear when we look into the history of what's happening, and that's the upward trend of the global economy. No matter how, we move up and down, because markets, they move. This is their nature. They go up, they go down, and it's a continuous cycle. But the reality is they will always trend upward. So again, something we keep getting asked when it comes to investing specifically, can I time the market? Can I know when to come in, when to go out? The reality is no, you can't. We've done a lot of research on the subject. There's a lot of research that's been done in the past on the subject that tells you exactly this result. So here I'm showing an investment portfolio of $10,000 again, because it's a simple example to take. And over the course of 30 years, 1990 to 2020, and different scenarios of people trying to see what was the best way to actually optimize for returns. And the reality is just starting and keeping your portfolio, you do so much better. than anyone who tried to time it. And this is, when we talk about, and I'll get to it very quickly later, but about active versus passive. But the first thing I want you to remember from all of this is plan and take action. Just do it. There is no perfect time. Now, the rule number one takes most of the presentation, Selma, so hopefully it will go a little bit faster moving on. But rule number two, when it comes to actually understanding how you can grow your wealth, is about diversification. We come from a region where we're very comfortable in investing in places we know, in class assets we know. I know for a fact, being Lebanese, a lot of people invest in real estate. That's one class asset only. And the reality is, again, look what happened in Beirut. You want to diversify. You want to make sure your money is put in different class assets across different geography, across different, economies and stages of economies. There's a very well-known economist, Harry Markovich, and he says diversification is the only free lunch. We see a lot of people trying to be active investors, which means trading. I come in, I buy and sell and buy and sell, and they try to beat the market. And then you have the other side that is the passive investor, which really focuses on minimizing your risk by preserving returns, putting your basket in a lot of different, putting your eggs in a lot of different baskets. Ooh, I live in Jumeirah and Dubai, and cars are crazy here. So do retail investors trade well? The reality is no. The very few that actually manage to do that are really lucky. It's based on speculation. So they trade too much, and this is a high cost. They sell the good ones, the good stocks, and they buy the bad ones. And the reality is we trade on old news, because by the time it hits the mass market, it's already had its impact. Beautiful, colorful chart. This is just to show you a quick example of, if someone wanted to invest in 2016 and they wanted to basically invest in emerging markets, which is the navy, the dark blue here. And they're like, I bet emerging markets are going to do really well. They were so lucky because 2017, it did really well. But then 2018, bottom of the list. 2019, it moved back a little bit. So this is just to say that no one can time or predict the market. The market moves randomly. What you can do is you can use diversification. And an easy way to diversify is through something called exchange traded funds, or ETFs. What are they? Baskets of securities. Basically, they're a bundle of, let's say, stocks. So there's an example here called VTI, which is Vanguard Stock ETF. And basically, it's an ETF that holds different industries within one. So you have, technology, healthcare, finance, and so on. The cost of one ETF is actually very low. So you can buy an ETF and you can be super diversified. Now put different ETFs together and combine them between different economies and different class assets, and you have what we call a very well diversified portfolio that you need to also make sure it's diversified properly based on correlation between the different ETFs. Number three is about cost. When we think about investing, the reality is, and I mentioned this in the panel before, is the region has one of the most expensive financial services in the world. So what we want to keep an eye on is what we're paying for, okay? So what do you need to know? You need to know that, as we said, compound interest works magically on bringing, wealth. At the same time, costs work the reverse way. They can chop into your returns really, really quickly. So we want to keep an eye on things like expense ratio, like trading costs. So again, if you're buying and selling, there's always a cost associated. Again, Selma, we have traditional advisors here that charge commission on the funds that they try to sell you. So that's a question you want to ask. Is there an entry and exit cost? We have a lot of horrible plans happening here in the region, a lot of, let's say, insurance plans where they tell you, you have to keep your money for 10, 20 years. You cannot access your money. At least I can tell you at Sarwa, we don't have that. There is no withdrawal penalty. You need your money, you're able to access it. This is something you should be able to ask about. Collection charges, if you're, let's say, paying with a credit card, sometimes they charge you and not the merchant, because if it's a financial institution, then the charges are on you. So all of these is to say, how much are you willing to pay for financial advice? Now, a rule of thumb, we always say, keep it below 1%. And that's really the main takeaway from this, is you want to keep it below 1%. Number 4 is all about emotions. We are an emotional creature. That's the reality. And, you'd have your investment, and if you see, the market moving down and things are happening and you panic, right? You panic and you're like, I want to get my money back. It's the worst thing you can do. Because again, in investing, we always say you only lose when you sell. So what do you want to do? I really like this quote. Far more money has been lost by investors trying to anticipate corrections than lost in the correction themselves. There's a very interesting study by Morningstar. It's a little bit old, but it's just to show an example. So they've done a study around 2017 where they looked into the average investor and what the average investor would earn in comparison to the market. So what is the market doing? And they looked into the specific fund, which was quite interesting. So over a period of 10 years, and this includes the financial crash of 2008. So the fund itself returned 3.9%, so around 4%, okay? The investor in the fund, they returned minus 15% because they panicked and they sold at very low prices instead of just waiting it off. This is, when we're talking about investment plans, we're talking about long-term. So you always have to zoom out. The reality is people tell you that the market is driven by greed and fear. So a lot of people, whenever it's doing really well, they get excited, they want to go in, and they end up buying at very high prices. And then whenever there's a drop in the market, they panic and they sell at very low prices. What you want to do is just nothing. Write it off. Or actually the opposite, if you're in a steady financial situation where you can do that. But the reality is we are bombarded by noise all the time. And what you want to know is block that noise. Just don't listen to the crazy media. When you're investing, it's a patience game. You have to really think about it for the long term. So the noise, put it aside and focus on what matters, which is building a proper, sound financial plan for future you, for yourself. So in general, how do you do that? Just again, like we said, block the noise. Don't check your portfolio if you have an investment portfolio. Consider your risk level. So again, risk is very important because if you're in a situation where you can't afford to take risk, then go with something conservative. I can talk about Sarwa later and how we do it. But again, just base your investment on where you are in your life and what's your situation. And speak to an advisor that you trust. But there's, again, a very known saying in investing that investing is like a bar of soap. The more you handle it, the smaller it gets. So ultimately, what should you be doing? 4, but I'll add one more thing. First step you want to do is take control over your finances. Salma, one tiny step backward is that I didn't really discuss is why is it important for specifically women to be financially independent? Because it gives us options in life. It gives us control over our life. We choose, if we have financial independence, what we want. You want to stay in your job or you want to leave? You want to, maybe, you're in an unhealthy relationship. That allows you to also be able to take that stepping stone and move on. It just makes you more confident in your decisions. And to get there, you need to just feel like you can take your financial situation and control it. Start by budgeting, having an emergency fund, and building on that and investing. Now, of course, again, it depends on people's situation. And it's not only for women, it's for men too. Financial independence is extremely important for everyone. But so rule number one is to be in the market, start investing, diversify, make sure your money is not put all in the same place, control your cost. And again, rule of thumb, keep it under 1%. Ask for the fees they charge you. Sometimes there are hidden fees. And ultimately, just don't be emotional and block the noise. And we always just end it here by stay healthy, stay safe, and stay invested.
Oh, thank you, Nadine. Very, very interesting topic, I think, and very timely, especially now for us in Lebanon, because in Lebanon, as you were saying, mostly the advice was invest in real estate, which turned out to be, or keep your money at the bank, which turned out to be very bad for all of us. So questions?
So this is the reality, Salma, and I'm pretty confident that probably all our participants know that whenever there's high reward on something, there's always high risk associated. And that's the example we've seen in Beirut, specifically in Lebanon, is you had high rewards, which really meant very high risk.
True. And actually they were not realistic. I have a question from Ms. Naila Yahya. Nadine, the question is, can you tell us a bit more about Sarwa itself and its investment portfolios?
Yes, of course. So Sarwa is, like I mentioned, an online investing platform, and it's very easy to use. You just go on the website, you register, you answer a few questions that help us to assess your risk profile to understand your personal situation. We have pre-built portfolios that are made of exchange-traded funds, very globally diversified. And then we'd recommend one portfolio for you. You accept it, you want to move forward, then you start the process of opening your account, and it's very simple. So again, we made it very easy. You just take a selfie, you upload your ID, so a passport or your ID, and a proof of address, and that's it. Your account is opened. You can fund it through a bank transfer. This is basically how we fund the account. And for anyone who's listening who's in the UAE, we actually have local accounts too, so you can transfer without any international fees. The portfolios, Salma, we have actually very broad range. So we have three main verticals. You have the conventional portfolios, we have the halal portfolios, and we have the socially responsible portfolios. And in each portfolio, you have the risk levels. So it goes from ultra conservative all the way to ultra growth. I hope that answered the question.
Yeah, thank you. Thank you, Nadine. We have a question from Monica Bazdi. She's asking, how can you keep your focus on the end goal?
Oh, okay. What the end goal for the investment, you mean?
For the investment,
I'm gonna, yes.
So, I think she means, maybe Monica can explain more, but I think she means, for example, when maybe you can think of selling your investment or taking the money, because you're saying that we need patience on that front.
True, very true. So it's, again, platforms like Sarwa, and it depends on where you are in the world, but and I'm pretty sure you will have probably available services similar, except in the region we are the only one that offers this. What we do is we take the emotion out. So once you fund your account, we really do a lot of education. We highly recommend, do not look into your dashboard a lot. Keep emotions in check. And let's say you panic. Let's say you want to withdraw your funds. When you actually send us a withdrawal request, we talk to you to understand, is it based on panic or need? Because they're two different things? Or did you actually achieve your financial goals? Because we actually work with you to understand this. So if it's based on panic, we try to talk to you, we try to tell you that this is not the right way. But if there's, of course, a need for you to actually withdraw, then you should absolutely have every right to do it anytime. So that's one of the ways where we say we help you get to that goal.
Nadine, I have a question from my colleague Pat O'Connell from New York office. He's asking you if you can elaborate on the poor results of high frequency trading.
Of course. One of my favorite questions. We actually have a lot of, we've done many webinars on specifically that subject where we show, the data and research behind it. The reality is, and there was a Harvard study that was done very, very detailed on the subject. The reality is a retail investor reacts to the market after the market has already been in motion. So when we come as retail investors, we come too late. We react based on stale information. And because we trade too much, there's always a cost that people don't talk about, which is the cost of the trade itself. That cost is eating into your returns. So if you were a passive investor that's all about tracking the market, that typically moves upward, trends upward, right? And you're not incurring these trading costs, this money is being put to work back for you. While if you're actively trading, you're actually incurring that cost. And the reality is, again, data over and over and over shows that no one can predict the market. And that's something, I'll be happy to send you across that.
We have a question from Petra Rad. She's asking, what properties should we set for the broker which we choose to help us buying stocks? I think she means how we can pick whoever we're working in stocks with.
Yes, of course. So choose someone who's fiduciary, someone who's actually working for your best interest. First, not based on commission. So that you want to eliminate right away. If it's a personal human trader, then it really is something that's very, I would say, when it comes to choosing a personal financial advisor, is very emotional. Because the reality, again, I always love to go back to data. What we've seen is that like financial advisors tend to recommend portfolios that they themselves actually invest in. There's something called a bit of the financial advisor bias, where they've seen that trend of someone, would recommend the same things that he thinks are good for them. But the reality is you are different than that person, and your financial situation is different than that person. That's why, at least for us, Sarwa, we rely more on technology and algorithms because we remove that human element out of it. But what you want to do is make sure they're regulated, first and foremost. We've seen it here. There've been a lot of Ponzi schemes, a lot of fraudulent play, and regulators right now in the UAE have been aggressive about going after these people. But they're there. So you want to make sure that whoever you work with is a regulated entity. Start with that, and then hopefully it will go well.
And there is an interesting question, Nadine, from Sarah Zahreddin. I'm not sure if anyone can answer this, but now in the current pandemic in Lebanon, what advice can you give me to start a business, and what kind of business works other than real estate?
Sarah, I wish I had the right answer, but what I can tell you is what we know from the global economy is always look into what the society at that time and place needs. What is a need that no one is filling and that you think you can actually solve for? So any sound business starts with that. That's the number one thing that you want to think about is in your capability. Do you have maybe a talent that you can monetize? Do you have something that you can bring to the table that people really actually will value? So even if it's not something where you have to, spend money building, but it's something you yourself think you can provide as, intellectual value, as a talent, then start with that. But make sure it's answering a need in the market.
Yes. And somebody is asking, Farah is asking, I think you answered that question, to go online and check Sarwa website, but she's asking if there is a minimum amount to invest in Sarwa, for example.
Currently there is, it's 500 US dollars, and we are actually working very soon on bringing that even lower. So again, when I said that one of the missions we had is to make investing available for everyone, we are really working towards that.
I think also we have a comment from Trustee Laila Psat. She's saying that even she does not have any business herself, but this was very informative for her. She understands now the steps, and she's going to advise her daughter about investment. Maybe Nadine, you can open your camera so that our audience can see you before we.
Of course, I really hope I don't lose you. So I actually moved in the house a little bit just so I can hopefully get some better connection. But let's see. Hopefully I'm still here.
Yes. So thank you so much, Nadine. That was very informative. I'm sure that our audience enjoyed as much as I did. And I wish that we could have this session face to face. Maybe in 2022, we will be able to see each other's like we used to do before. And thank you so much. We're proud of you. AUB is proud of you.
It's really my pleasure. Thank you. Thank you so much.
And
It
we'll
was
definitely check Sarwa website.
Anything you need, I'm here. Thank you so much.
Thank you so much. Bye. Bye, everybody. Thank you.
Have a lovely rest of the day.